Good morning. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with my colleague Allison Schrager, as well as Catherine Rooney Vera. She's chief market strategist at StoneX. We're here to talk about CPI, take it in real time. The expectation for the number, which is set to come out in about 5 minutes, is that month on month, consumer price index will tick up seasonally adjusted 0.2% on the core, which excludes volatile food and energy. The expectation from a consensus of economists surveyed by Bloomberg is also that it will tick up 0.2%. And on a year-on-year basis, that would bring us to 3% on the headline, 3.2% on the core. The basic setup here is we've now had about a quarter of very encouraging inflation data. I would say that comes in the context of about 9 out of the past 12 months looking pretty good. But that first quarter was a little bit rocky. It was unsettling for some of our monetary policy leaders. And so the idea here is that even though there's an expectation that there will be some Fed cuts later in the year, there are still a few holdout members on the Fed's rate setting committee that don't seem totally convinced. And they say that they're looking for additional evidence before they're ready to pull the trigger. The Fed Governor Michelle Bowman on Saturday saying that she still sees inflation uncomfortably above the committee's 2% goal. The Atlanta Fed President Raphael Bostic saying this week he's looking for, quote, a little more data before he'll support an interest rate reduction. Catherine Rooney Vera, what kind of evidence that we might get today might constitute that kind of evidence that would give a Michelle Bowman or a Raphael Bostic the confidence that it's time to cut interest rates?
I think it's widely expected, John, that shelter costs are going to be disinflationary finally, right? The Fed has been waiting for that for an extended period of time. If that doesn't turn out to be the case, or service sector inflation ex housing doesn't in fact continue to disinflate, as we've seen some positivity there over the past couple of months, then I think the Bowmans and the Bostics of the world could be on the right side of history. But certainly, I think at this point, the data that we're looking for today, I think, is going to help us determine, at least from a market perspective, how big of a cut September's is. Not if we're going to get a cut. Will it be 25? Will it be 50? Will it be something even more?
Okay. All right. Allison, for you, what constitutes sufficient evidence at this point of not just ebbing inflation, because we've seen that, but this idea that, this is going to persist. There's a diminishing risk of a resurgence.
Well, I'll never give up on the idea there could be resurgence. I mean, there's so many structural things in the economy. But I would say this spell of inflation looks like, I would say, it's summer. I would expect this report as well to reflect some of this, to be a good report. But I would be curious to see how it holds up to a spike. If, I like some stress testing. I'd see it. Energy prices have been coming down, and that's really helped inflation. So I'd like to see how inflation numbers really respond, and can they hold up to sort of higher energy prices, although that might be a long time. But I would say, yeah, if we made it through the fall with a bunch of other good reports, I personally would feel a little bit better, although I'm not saying the Fed needs to wait until then.
Right. Well, and we're going to get another one of these before the FOMC meets in September. We're also going to get a key speech from Jerome Powell in Jackson Hole that everybody will be looking forward to. But so there is time for additional evidence here, but this is certainly going to set the momentum in fixed income markets going ahead for the next month here. When the numbers do drop, we'll of course want to look at the decomposition. Catherine underscored this key piece, housing, which did seem to be easing a bit in the last report. So we'll see we'll see where we go from there. And there you have it. So bang on 0.2% month on month on the headline, 0.2% month on month on core. And then you do get the headline coming in a little bit lower than expectation on the year-on-year figure. We actually get a two handle, which maybe from some weird psychological standpoint might feel good to people. So 2.9% year-on-year is your inflation in the headline CPI, and then 3.2% is where your core sits at the moment. I'll take you over to markets real quick. And in your intraday move, the market's kind of trying to make up its mind here. Bond yields had been drifting a little bit lower heading into this number. And there is, some funny knee-jerk reaction business going on here. A line lower, a line higher. I tend to give it a couple minutes on a day like today to figure out what kind of direction we are actually going to take here. Allison, I'll come back to you because you always have some interesting views on uncertainty. How do we feel about the BLS number delivering exactly what the markets were expecting on this Wednesday morning?
It's super important because it's not just it's not just that the number is lower, it's that people expect it to be lower and their expectations are met, because the uncertainty is often what certainly drives a lot of the risk premium, a term premium on the bond market. So the fact that people are able to predict what's going to happen is pretty good. I'm not sure if it goes for the right reasons, but in some ways it doesn't matter. I was just looking at the numbers too, and I think one of the more exciting things to note is that used cars really driving down inflation, a lot of disinflation there, which I just think is interesting, because remember when inflation went up, everyone was like, it's just the used cars, just inflation there, no show here. They waited a year to increase rates because they're like, it's just used cars, and now it's also just used cars, but just going in the right direction.
Fair enough. I did also put up on the screen here our implied overnight rate, basically the implied path for the Fed based on futures trading, and I don't see meaningful moves in this at the moment, but I just wanted to point out, now the market is essentially priced for a pretty steady path down to about 3%, 3 to 3.25% towards the end of 2025. The market's expectation, which I think is a reasonable one, is that this is going to be a slow process. Aside from maybe some front loading in the very beginning, nobody is expecting that this is going to be a breakneck pace kind of thing. But this is a market that is kind of priced for the idea that this issue is over. It gets in, if you look at this graphic, it gets into some hairy questions about what the terminal rate is, what so-called R star, the neutral, the real neutral rate of interest is in the long run. And we have a market basically implying that's that we're going to land somewhere around 3%, which is higher than what we would have thought in a not so distant past. But Catherine, what's your outlook for bonds at this point, given that all of this is already priced in?
Yeah, that's true, John. A couple points to make. One, I think to answer your question directly in terms of bonds, I think we need to be in the steepener. I mean, this is a consensus trade, but I do think there's more upside. There's probably more upside on the back end because term premia are going to continue to rise given the profligacy on the fiscal front. But I'd like to get back to some of the data under the hood, because you look at shelter index. And now when we do an analysis of what the contributors to the inflation really are, especially on the core PCE front, they're primarily two things: housing x services x housing, and housing. And so we look at shelter index, which accounts for, as Bloomberg reports here, 90% of the monthly increase. It rose 0.4%. In June, it rose by 0.2%. So something's got to give here. In my opinion, if you have two basic motors of inflation, one is rents and one is services x housing, and neither of them seem to really be budging, then it's very unlikely the Fed hits the 2% target for the foreseeable future. So either my opinion, it may be somewhat controversial, is that I don't think we get to 2% without a recession. I just don't think we do, because service sector inflation is the main driver of the economy ex housing. And unless housing really gives, it's hard to get to that 2% target. Why would people's habits of consumption change when, if the unemployment rate hasn't skyrocketed, if guys and gals still have jobs, their wage growth is beating inflation? Why would their habits of consumption, specifically for services, which is the main driver of demand for goods or services, why would that change? I don't think we should expect it to. So I think that the Fed does cut. I think they want to cut. I think they need to focus more on the unemployment side than on the inflation side. At this point, I'll finish with this, John, is that good news is now good news, bad news is now bad news. If the Fed is able to cut because of their inflation target, that's good. If the Fed has to slash rates because unemployment surges, which historically is the case, historically unemployment rate, it doesn't just tick up like the SEP shows. It either jumps or it drops. So I think that the uptick in unemployment is somewhat concerning. It's concerning to me. I think it's concerning to the Fed. I think they have to get ahead of this, because what they don't want to occur is an unforced error in the sense of precipitating the recession that they otherwise could have potentially prevented.
So does that mean you think they're kind of giving up on the target then? Because if they start cutting rates effectively to neutral, and I think you make a good case that 3% might just be where the economy is. And, it's not a bad economy, and 3%, it's higher than people would like, but it's not like terrible. We could live with 3%. Inflation certainly has been higher in the past, and people's lives went on. So if they start cutting and start a path back to neutral and inflation hangs out at 3%, are they just implicitly giving up on the target? I mean, to be fair, they've never really have made the target. They were too low, and now they're too high. But
Allison, I think they already have, in a sense. Think about it. When you look at the summary of economic projections, the same Fed, the monetary entity, doesn't see inflation getting to 2, and they're not even trying to get to 2 for the next couple of years. So, I mean, that to me says, all right, it's not like really urgent for the Fed to hit 2%. They're not even trying to average 2%, because that implies inflation rates below 2. So the Fed doesn't even see 2% for the next few years. So I think that tells us something. So I think they'll never change it explicitly. I think it would be the biggest hit to credibility you could possibly imagine if the Fed changes explicitly its target before reaching said target. But implicitly, I suspect they have. And I think they're comfortable. And Jay Powell has said this many times. He's going to cut before we hit the target. And that leads me to my final point, which is I think that the long run interest rate is no longer, 2.5%, 3%. I bet, without recession, Allison, I think we go from 5.25, 5.50 now. I think we go to 4, but I don't think we get below 4% without a recession in terms of funds.
For nominal.
Yeah, exactly.
So even, so that's even a little higher on the real side, which I think they're also sort of teeing up that argument as well, is that rates are going to 0.
What do you think, Allison?
Well, I agree. I mean, I've been saying for a while, I think inflation might just be structurally higher in the economy than it was pre-pandemic. So 2% might be too much. I mean, intellectually, I'm just sort of curious what that means for I mean, this is less important to markets, but just interesting to me as an economist of intellectually the future of I was raised as an economist on inflation targeting being the be all end all. Right. But now we've had this target for 15 years and the Fed has never made it. And as you say, has pretty much given up on it. So, I mean, how much longer do we have this pretense of inflation targeting?
Well, let me stick up for my friends on the Fed here. Hold on. Now, first of all, the notion that they've given up on this, I disagree with that interpretation. I hear you, Catherine, insofar as the Fed has been willing to tolerate higher inflation in the short term to deliver the so-called soft landing and sort of balance their two goals here. However, there's sort of no question to me. Very clearly, they have their long run inflation figure landing at 2%. So they do have it getting back there. And then the other piece here, the other piece here, this idea that we'll never get inflation, the inflation genie back in the bottle. I feel like it's already there. I mean, okay, so number one, we've got some base effects going on here. I don't have my Texas Instruments from the CFA program here, but I'm pretty sure the 3-month annualized version of core CPI is right around target, maybe even lower after this number. It could be sub 2%. I know that's complicated. People say, there's this excess seasonality in the numbers. Don't do that 3-month thing, John, but it does matter. You got to look at the full picture. I take year on year, I take 3-month, I take 6-month. In addition to that, as you point out, Catherine, a lot of what is keeping us high here are these sort of imputed categories, these modeled categories that this owner's equivalent rent that is really keeping us on the high side. This is not something where I can go out to Walmart or my neighborhood Publix and like observe on a shelf how much does this thing actually cost. It's a highly modeled estimate that has been shown to move slowly, and I think that the more real-time data has continued to show that we should expect further disinflation in the pipeline. Your counterpoint.
It's hard to expect further disinflation if the economy continues as robust as it is. We could talk about potential growth, and I'd like to hear what you, Allison and John, calculate as potential growth in the United States. I calculate it as 1.8 to 2%. We're growing above that. The output gap is positive. So in an economy operating above potential, that's inherently inflationary. So it's really hard to see how miraculously we get to 2% outside of recession when the main drivers of an economy based on the consumption of services, with 2/3 of the economy based on consumption of services, with consumption of services being the primary driver of inflation. It's really hard for me to see how we get to an average of 2%. So the economy has to slow down, meaningfully. And I think that there's a very fine line. It's a very delicate balancing act, John, for the Fed. And I'm not laying blame on. It's tough, but it's also somewhat of their own making. Okay, the housing market, people have refinanced massively. So the Fed kept rates so low for such an extended period of time. That's why we haven't even seen a credit cycle. I talk about this with our StoneX clients all the time. I just came back from Costa Rica and I gave a speech there, and I said, think about it. Why haven't we had a credit cycle? The Fed has hiked to 525, 550 over a little bit over a year. We really haven't seen any defaults on levered loans. The housing market, guys and gals can't sell their house. Why don't they sell their house? They've locked in 2.3, 2.8, 3% 30-year mortgages. They're coming down, but we're still more than double that. So the effective mortgage rate is way too low for guys and gals to sell their houses, to not be able to buy an equivalent quality house. So that's because they refinanced. Same thing with the high yield market, with the lever. Corporations have pushed out the maturity wall. So we're good for now. But the truth is that economic cycles are real. They're not made up. And because I don't believe the structural argument, COVID changed us fundamentally. I don't buy it. I think the fiscal deficit in the US has helped prolong or delay recession, but recession is an inherent part of the economic cycle. So I think I think there are underpriced risks. And for that reason, John, I've been recommending to our clients that even in times of complacency, euphoria, and even greed, which I think are prevalent right now in the market, to take those opportunities and to protect positions with options. And that's been one of our best calls at StoneX year to date, which has been buying puts on tech, on NASDAQ. When times are good, it's like fire insurance. You don't buy insurance when your house is burning. You buy insurance when everything is great. So that's my call. I like gold. I like puts. I like 2 to 7 year U.S. Treasuries, and that's where I would be finding opportunities today.
All right. So let's go into the decomposition here. You two have both made some excellent points about what's going on under the hood. I have up on the screen here our decomposition from the ECAN screen on the Bloomberg terminal. And so first high level takeaway is as let's see here. Okay, so I feel like let me reload this. Give me 1 second. All right.
Shelter definitely disappointed, don't you think, Allison and John?
Sorry, what?
Shelter definitely disappointed.
Yeah.
Yeah.
At what point do you see owners equivalent rent by the Chicago Fed new tenant index? That's collapsing. At what point do we see that flow into OER?
Yeah, I would have thought you would have seen some more encouraging news here. Of course, the all tenant regressed rent index, which has proved a really great forward indicator for what happens in OER, suggested that we should see some really encouraging developments for the quarter as a whole. So, I mean, maybe they get sort of backloaded in the later months. I don't know, or maybe it has ceased to be a great forward-looking indicator. But as you point out, here's the here are your key takeaways, right? So number one, it's a bit of a soft 0.2. That's coming from the biggest contribution by far is shelter. I mean, shelter was everything this month. I think it's kind of fair to say that in the here and now, if you solve shelter inflation, which again, I'm sort of arguing isn't even a here and now problem. It's like a modeling problem, to be honest with you. But that's just that's my argument. If you solve this one component, inflation looks a heck of a lot different in the United States of America. Transportation services ticking up a little bit after being sort of a deflationary force in May and June, but this contribution looks pretty benign. Recreation services, sort of nothing doing. I do want to take folks over to core goods specifically. I'll change this to percentage change per component. I think that can sometimes be a little bit more intuitive. So core goods, you get a major deflationary force from apparel, transportation, commodities. Now that was what Allison brought up a little bit earlier. So new vehicles coming down. We finally got that discounting returning to dealer lots. People are no longer paying sticker, or in some crazy instances above sticker for their new automobiles. That's good. Used cars and trucks, big, very meaningful drop in the month of July, following similar in June. I kind of look at this, and I have two high level takeaways. And the first is basically we had inflation in the month of July because of shelter. And the second is people keep telling me that we're going to run out of runway on the core goods deflation or disinflation story, and it doesn't seem to be running out. Maybe it's as maybe I'm being like blinded by recency bias, but I look at the past. I look at the fact that core goods in general has been a deflationary force. I'm talking pre-pandemic. Why wouldn't we just be returning to that world, Allison?
Well, it could be. I mean, I'm a little concerned. The PPI yesterday did have goods inflation being up, but margins being down. So, I mean, it could be that you could take that as we are running out of runway. But I mean, I think one of the reasons I've always thought that might be true is we had these huge sort of supply constraints that drove up the price of goods, and those supply constraints have been resolved for quite a while. Yeah. So the question is how much more deflation can we really get on goods at this stage?
I think it's negative base effects. I mean, we've already seen the deflation, so I think that what you're going to see is it's an uptick because of base effects. I think that's going to be the story for core goods going forward.
Yeah. Well, I will take you back to a quick market check. We do have yields moving a little bit higher on the day, pretty negligible for what's been a very volatile market, but from the time of the release, we're up about 4 basis points on the 10-year. So maybe folks were hoping for a downside surprise on this core CPI print and didn't exactly get it. Okay, so
John, if I can just jump in
please,
on that.
Please.
Yeah, because on my team, we did an analysis of this. And so I was kind of hoping to use it today, but we came in line. So when you look since 2021, what the average market reactions were for a cooler than expected inflation release, a hotter than expected inflation release, and an inline inflation release, just looking at 10-year yields for a 1/10 miss on month headline inflation, that means inflation's cooler than expected. 10-year yields usually drop 10 basis points, and that's disproportionately more of a reaction than were inflation to surprise to the upside, meaning hotter than expected. If that compares to a 1 basis point move in the release that is hotter than expected. So in my opinion, markets are predisposed to revert back to this Goldilocks scenario, this everything is awesome trade, this perfect, not even soft landing, this ideal landing scenario. And that worries me. And I'll tell you one final thing, which is when we had that 5% correction a couple of weeks ago, when market chatter was the Fed has to do an emergency cut. And that is also somewhat concerning to me because it's a 5% move. It's an unwinding of leveraged bets, and the market's already saying, "Fed, get behind us." So I think that the data show that the market is very needy of a backstopping from the Fed, and I think that's what historic data has shown. So when we get a cooler than expected print. Great. The Fed's going to start cutting rates. Everything is awesome. The economy is going to avoid recession. And my advice to clients is a cautionary tale. I think at a minimum, protect your gains. I think it's time to protect your gains. And this is something that I said back on July 26th in a publication to clients saying, guys, you can buy really cheap put options. You can roll them 30 days out, roll them. And when we got that drop, that seemed like a pretty wise move. Now markets are back to kind of like everything is great. So I think we got to be wary. We haven't even talked about the election. That's another volatility issue. Geopolitical risk, another issue. I think volatility is going to increase. I think the downside risks are greater than the upside risks at this point in time. And I think the risk of recession in the United States of America has increased markedly. And I think it all comes down to, and maybe John, we talked about this before this live stream started, but I think it's all going to come down to the labor market. So as you had mentioned, JOLTs are important. Initial jobless claims are important. Non-farm is important. What's going on under the hood of the unemployment rate? Is it really still this combination, as my dear friend and lovely person, Claudia Sam, has said, is it a combination of both new entrants and actual firings? We have to watch that. So I think that's where it's at, especially in a consumption-based economy with inflation primarily driven by the consumption of services.
What do you see causing a recession? Is it like some external shock just is going to like set everything on fire that we have yet to see? Or do you think there's some weakness that hasn't played out yet?
So we have this phenomenon of job hoarding over COVID, and we have not seen that unwound. We saw Intel come out with something that I suspect would be the impetus to a surge in unemployment, and that is cost cutting. So, not to sound too crude, but cutting the fat could come into play when you have companies trying to shore up their bottom line to make those double-digit earnings expectations that are required to validate the multiple expansion that we saw last year, right? So you have corporates that facing 3 input costs that are very, very high. 1, labor, 2, real rates, and 3, energy costs. Input costs are high. So, we have yet to see an unwinding of the job hoarding phenomenon. That's been my view for some time. It hasn't played out yet, but I think that's the quickest path to cost cutting is letting go in an economy that has labor market flexibility, which we have, which Europe does not. The United States has that labor market flexibility. I suspect that would be the impetus to a curbing of consumption, which, as I've mentioned multiple times, Allison, is the main driver of the economy. So I think it's really hard to see inflation moving down to 2% when you have, pretty robust labor market, pretty strong economic growth, and confidence in the labor market. People are still going to consume. So something's got to give. And I'm not calling for recession, but I do think the risks are much higher than currently priced in the market. I have a 40% probability or chance of recession over the next 12 to 18 months.
All right. Well, I think we do have to leave it right there. But to sum things up for you all, there's a lot of reason to disagree in these numbers. On the one hand, your headline year-on-year CPI number comes in at 2.9%, still clearly well above where the Fed would ideally like it at 2%. However, on the flip side, I do have confirmed for you that 3-month annualized core CPI falls to 1.6% with this on the seasonally adjusted basis. So, 2 interpretations of the same data. Another key point you want to take away from this number is it's all about the housing, and people are going to have different interpretations of what that means. Perhaps the more dismissive angle that I've tried to present, and some real reasons for forward-looking concern that Catherine has underscored here as well. We will leave it right there. Thank you very much to my colleague Allison Schrager, Bloomberg opinion columnist, author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. Catherine Rooney-Vera, Chief Market Strategist at StoneX. Thank you very much, and please join us again for the next one.
Thanks, John. Thanks, Allison.